So chapter 5 is a very interesting chapter because it introduces us to merchandising operations, which is just a nice long word indicating any business that sells merchandise. The biggest part of that are retailers, and you've all been to a retail store. So we're going to be spending a lot of time on that. And then you're going to learn an expanded version of the income statement later on called the multi-step income statement, which is one of my favorite things. But today we're going to focus on learning objective 1. So learning objective 1 gives you sort of the overview of merchandising. So when we talk about merchandising, we're talking about companies that buy and sell goods. A good is a physical product, okay? Versus the previous chapters, we've been looking at a service business. Sierra Corporation did tours, that's a service. In this chapter, we're looking at companies that buy and sell goods, merchandising. So these are physical products. And you are very, very much aware of many larger merchandising companies like Walmart and Amazon. You might not be familiar with REI, Recreational Equipment Incorporated. They are sort of like it's a sporting goods, outdoors types of store like Dick's or Modell's or Cabela's or things like that, sort of wrapped in all around. I don't think there's any in this particular area, this part of New York. There are a couple in Massachusetts that I've seen when I visited up there. But they're, again, it's just a retailer. Understanding how all this works is very, very important, okay? Before you walk into a store to go shopping, so say you go to your local Walmart, when you walk into Walmart, you'll see all types of merchandise, right? All types of goods on the shelves, right? Well, Walmart had to buy all of that to put it on the shelves first. And then they sell it to you, okay? So what happens is, and wholesalers, this doesn't happen in a lot of industries anymore. Companies like Walmart deal directly with manufacturers. And you have to excuse my cursive there. Manufacturers are very important because manufacturers are companies that create and design and make goods, okay? A lot of people in the country worry about the fact that many different types of jobs in factories making the goods have perhaps gone to countries like China, where costs are a little bit lower, you could say. Well, you got to look at the big picture. That's not all that what a manufacturer does. Manufacturers create products. Before you can make anything, you have to know what you're making. And that means it has to be created first. So the creation of a product leads to things like patents and copyrights and things like that, things that are very, very important assets to companies. And that is still an American shining star, okay? We might not necessarily be having lots of factories that actually make much of this stuff, but we are number one in the creation process. There are more patents for inventions coming out of America than any country on the planet. And because of that, manufacturing is quite alive and well in the United States. The making of that is the very last step, right? Making a product is the very last step in the process. If we were losing, we're losing out on that a bit. If we were losing out on the creation process, if we were losing our innovation and creativity, I would be extremely concerned for our future. But the fact that we are still leading the world in inventions of new things means that we're in very, very strong shape, even though we might be losing the last piece there, the making of the products. So companies like Walmart or Amazon deal directly with manufacturers. They buy goods from manufacturers. So because they have to buy it, there's a cost that's involved. Okay, there's a cost that's involved because Walmart, like I said, has to buy the goods from the manufacturer first. Then they sell it to us as consumers. Okay, so then they charge a particular price that you and I pay, right, as consumers. That's their revenue. For a retailer or for a merchandising company, their revenue account is called sales revenue. The word sales is consistent with goods. Okay, so every time you see a company and has sales revenue, they're selling a physical product. Okay, so just keep that in mind. But again, there are costs that are involved. So Walmart has to buy the stuff, put it in their store, and then they resell it to us. So the price that you and I pay, right, for goods is going to be higher than the cost of those goods to the retailer, because that's how they make a profit. Okay. The prices that you and I pay at the store is the sales revenue for the retailer. So for example, you walk into Walmart and you buy a backpack. Right? The price you pay for the backpack might be $30. That $30 is the revenue to Walmart. They're going to put it as sales revenue to Walmart. The first thing they're going to do is they had to buy that backpack before you bought it from them. So they're going to subtract out the cost of that backpack. And the difference is going to be what they're going to call a gross profit. They need to make money. They have to pay all their bills and make a profit from the difference. It's quite a trick. It's quite a trick. And it's not easy to do. Not easy to do. Just because Walmart is one big company, it's the biggest retailer we have on the planet, doesn't mean that it's a highly profitable business. Okay? Because there are differences in what the company can make. So a couple of quick recaps here. Merchandising operations, we're talking more or less any company that buys and sells goods. Walmart is one of those companies. They have to buy goods, put them in the store, and then they sell those goods to customers. When they buy the goods, they have to pay for them. So there's a cost that's involved for those goods. Then they sell those goods for different prices. The prices are what customers pay, but the company looks at those as sales revenue. Okay, so the prices you and I pay to a company is their sales revenue. Okay, so very important. And all of these merchandising companies work the same way. Which means that for a merchandising company, their income statement's a little bit different. Okay. Like I said, they start off with their revenue. In a merchandising business, that account is called sales revenue. Okay, sales revenue is their revenue account. The word sales is synonymous with goods, physical products. The first thing they do is subtract out the cost of that good that they sold. This cost of goods sold is an actual account. Remember, we're doing accounting. You're learning about accounts. This is an account, cost of goods sold. It's an expense account. Okay, it's an expense account. So you learned a new expense account here. They subtract out the cost of that good that they sold. The difference is something called their gross profit. The gross profit is simply the difference between the prices that you and I pay for the good. Okay, so this is the prices that customers pay, which is the sales revenue to the company, minus the price the company paid for the good. That's the cost of the good. That's the gross profit. From the gross profit, all the other expenses are subtracted, leading to either a net income, which is a profit, or a loss. Now, just because Walmart has over $500 billion in sales, and you heard me right, it's with a T, $500 billion. Walmart is a huge, huge retailer. Doesn't mean that they're keeping much of that after this process is done. Okay. As a matter of fact, for every dollar the customer gives Walmart, and they give Walmart a lot of dollars, as I was mentioning, after they subtract out their cost of goods sold, after they subtract out all the other operating expenses, they're only left with about 3 cents on every dollar as their profit. Now, of course, they do have over $500 billion in sales, so the profit is pretty large. But if you break it down on a dollar basis, they're only keeping about 3 cents of every dollar as their profit, which means 97 cents out of every dollar you give Walmart goes to pay for all their expenses. Okay, so this is what a merchandising company is like. Okay, now let me keep going here. So in terms of the operating cycle, it's very different for a merchandising company than it is a service business. Service businesses perform services and collect cash, either directly or through accounts receivable. So it's a very, very quick cycle. For a merchandising company, again, they need to buy the goods first. Remember, before you walk into any retailer and you see all those products there, that retailer had to buy all that stuff first. Okay. When they buy all those goods, that's an asset. Okay. It's called inventory. Inventory is an asset account. You've been introduced to inventory earlier on in the chapters of this book. Okay. The purpose of this inventory is to sell it. That's how they make their living. Retailers or merchandisers sell inventory for a living. That's it. So this is going to be a current asset because they're going to want to get rid of it very quickly. Okay. They sell their inventory. They're either going to collect cash for that inventory, or in some cases, they may sell to certain customers on account, in which case they're also going to be having a receivable and collecting that. Once they get the cash, guess what they're doing? They're usually buying more inventory. Okay. So in essence, it's a constant cycle that's going on in retail. So you've already learned two very important accounts. You learned cost of goods sold, which is an expense account in the last slide, and inventory, which is an asset. Okay. Very, very important. How inventory works and how the flow of costs work in a retailer mimics the fiscal year, right? At the beginning of a fiscal year, they're going to count the inventory in the store, and that's going to be their beginning inventory. Okay, so this starts, I'll just make it, say, the first of the month, right? January 1st. Then through that period, of course, you're going to need more. No one wants to walk into a store and see a lot of bare shelves, right? So basically, companies are always buying inventory and putting it on the shelf. There's always inventory coming in. So they're going to have costs of all those new goods that they've purchased. Between the beginning inventory and what they're purchasing, that gives them all of the goods that are available for sale to customers. Now, That's important. This is their inventory, okay? It's their total inventory. Only two things can happen to inventory at a merchandising company. At the end of the period, and again, I'm going to put this down as the very end of the period, so I'm just using a calendar. Whatever is left in the store is their ending inventory. Okay, ending inventory is an asset account. Whatever is not in the store, we are assuming we sold it. We are assuming that we sold it. And thus, the cost of that inventory is going to be cost of goods sold. So the good news is only two things can happen to inventory once you buy it. At the end of a period of time, you either still have it in the store, in which case it's still your asset, still inventory. If it's not in the store, in accounting, we assume it's been sold. And if it's been sold, we can expense it as cost of goods sold. Okay. This chart is going to be very important to you later in this chapter. So you want to make sure you are looking at this down the road. So in terms of how companies track all of this, most companies have an automated system called a perpetual inventory system, which means that it's all computerized. There are barcodes on everything. And so when merchandise is coming in the store, they scan it in. And then as customers buy it and the cashier or customer scans it out, you know, that wonderful noise that you hear, boop, 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 you know, every time you're checking out, that's taking the inventory out as well. It's doing a lot of things, that computer system. But that's a typical hallmark of a perpetual inventory system. They're constantly keeping track of inventory coming in and coming out. Smaller companies, and prior to the days of computerized systems, they would use something called a periodic system, which is simply a physical count. So at the end of a period, say at the end of every month, these companies would physically count the inventory to find out how much is there. And that's how they would go ahead and do their flow of costs. Thankfully, we have perpetual systems in place. It doesn't mean that we don't use a physical count. Even companies that use a perpetual system still have to do at least one annual physical count to see if their computerized records are accurate. Okay. So again, a perpetual system of inventory continuously updates the inventory. And maybe some of you have worked in retail, so you know when goods are coming in, when you get a shipment of goods, you're scanning that into the system. And then of course, as they're sold, you know, the computer's scanning them out. That gives you an updated inventory of every product that you scanned. Okay. That's basically what we've got. But we do have this idea of physically counting, okay, the inventory by hand, in which case that's a periodic system. It's a periodic system. So the chart I showed you just a couple of slides ago basically shows how this periodic system works. We start with whatever inventory is in the store at the beginning of the period. We add all the inventory we bought. That gives you your total amount of goods available for sale. At the end of the period, we count what's left. This is our inventory. If it's not there, we assume we've sold it. So this 5-step process and the chart are the same. Okay. Okay. So this is the end of learning objective 1. Series of true/false questions are upon us. So let's do one at a time. The primary source of revenue for a merchandising company is not performing services, but selling goods. So it's sales revenue. The operating cycle of a service company is shorter than a merchandising company. Yes, because there's no inventory to worry about. Sales revenue less cost of goods sold equals gross profit. That's true. This is something you have to know. Okay, so this is, I don't have you memorize too much in this class, but this is one of these things that you really kind of need to know. And the last one here, you have ending inventory plus the cost of goods purchased will equal the cost of goods available. No, it's actually the beginning inventory plus all the goods you bought equals the cost of all the goods available for sale. Okay, so those are the main points of learning objective 1 in this chapter. As you see, it's different. It's different than what we've been doing before. So it's time to kind of buckle down on this.